Welcome back to On the Move. I'm Julie Hyman, and Dan Roberts. We continue to see stocks fall.
Yes, we do. We are watching closely after that emergency Fed cut. The U.S. Federal Reserve today announced an emergency 50 basis point interest rate cut, and this is in a bid to shield the longest ever economic expansion from the impact of the spreading coronavirus. Stocks, though, have not reacted so well in the last 30 minutes or so. Joining us now to discuss, Vincent Reinhart, Mellon Chief Economist and macro strategist. He is on the phone. Vincent, thanks for calling in. And I guess I'd start by asking you whether the Fed needed to do this right now, because there's been some question about why not wait until the next meeting. This is a little bit of a surprise today, and for the moment, it hasn't really helped stocks.
Yeah, I'm actually at a loss to justify a substantial lowering of the policy rate between meetings. Historically, the FOMC is reluctant to do an intermeeting move on the fears that it looks like it's panicking, that it conveys concerns about the economy from some insider knowledge. It feeds suspicions that it's responding to equity moves, and lastly, that it feeds suspicion that it was influenced by political actors. And the Fed basically went 4 for 4 this morning. Chair Powell's press conference was pretty underwhelming in providing the rationale. He did talk about business contacts, which I think led some people to wonder if they knew something we don't. They did it the week after equity prices fell 11%, and he called a meeting of his colleagues immediately after returning from Secretary Mnuchin's office. I could understand why equity investors are somewhat perplexed.
Hey, Brian Chung here. The optics of this are certainly something to be examined, but I've been covering the Fed, and inside a lot of these meetings, you've been hearing a lot of Fed officials talk about the idea of, with interest rates being so low, you have to act early and aggressively on interest rate moves to try to hedge against any sort of possible thing coming around the corner, which seems to be the case here with the coronavirus, at least as Jerome Powell was messaging in the press conference. I'm wondering what you think that kind of tide in thinking at the Federal Reserve factored into the decision to emergency cut today, when you consider that the Federal Reserve has really been obsessed with this idea of moving early and aggressively if it needs to get ahead of the next big thing around the corner.
Yeah, that's page 1 in the talking points on how to deal with the zero lower bound to nominal interest rates. If you think you're going to get a persistent adverse demand shock that could risk putting you at zero, then go low as quickly as you can, because the economy will be in a better position at that juncture. The problem is that is when you believe you're going to have a persistent adverse hit to aggregate demand. Most analyses of the economic effects of the coronavirus talk about the V. The coronavirus is expected to impart a V-shaped dent in global activity, albeit deeper and more asymmetric than we might have thought a couple weeks ago. But the funds rate appropriate for the downward leg is not the same as for the upward one. That's particularly going to be a problem, because what you have to explain to me is how the Fed could possibly take this back in the course of 2020, an election year.
Vincent, Oliver Porsche here. Do you think that the Fed's obsession with equity market moves is going to create some real issues down the road? At the end of the day, they only have so many bullets in the chamber, as they like to say, and they just spent 2 of them. To me, it seems like if there is another downturn, and we can see that black swan events can come out of nowhere, that's what this is at the end of the day, creates a real issue for the Fed.
So I think you're exactly right, and there's no getting around it. Jay Powell owns the Powell put. We know that 11% on the S&P is sufficient to invoke it, to get 50 basis points out of it. So does that mean if we get 11 more times what we've seen since he spoke, that they'll move another 50 basis points? He set up moral hazard in a big way.
In addition to talking about this being reactionary to equity markets, one of the things you mentioned earlier was that this could be perceived as political. Not only is this election year, this is happening on Super Tuesday. Is there any way that they could be looking at this as maybe some way of moving into, Super Tuesday and who the Democratic nominee might be?
So I'm not sure it's as finely tuned to that. To me, the political event that I worry about is the the conference call of the G7 finance ministers and central bankers. There were 14 people presumably taking part in that conference call. Only one of them really had policy room and the flexibility to make changes in policy, and that's Jay Powell. And I think everybody just looked at him and expected him to act. So in some sense, the concerning message right now is that Jay Powell has Secretary Mnuchin's back.
So I guess the question now is, what happens from here, Vince? In as much as we can estimate what happens from here, right? Not knowing the trajectory of this virus, but as an economist, knowing what you know, economic data-wise, what can you predict in terms of economic trajectory?
So I think in the near term, events are probably going to break the Fed's way in interpreting what they just did. As the infection spreads around the world, the news on confirmed cases and fatalities are going to look grim, even as cases top off in China like they seem to have been. We're also entering the time frame in which data are going to roll over because of the earlier disruption in economic activity. That's the downward leg of the V. The Fed's going to have a problem on the upward leg of the V. If we come to accept that coronavirus is just a branded name for the seasonal flu, and we get past that, then there should be a snapback in economic activity. There'll be a loss on the year on net because the snapback will not be as bad as the downdraft, as favorable as the downdraft was bad, but we will get the snapback, and the funds rate that they seem to think is appropriate on the way down won't be the one that's appropriate on the way up, and that'll be a problem for Powell. It will also be a problem for Powell because the election year is going to freeze the Federal Reserve in place.
All right, that is Vincent Reinhart, Mellon Chief Economist and Macro Strategist. Vincent, thanks for calling in.